If you're thinking about selling your home, you might be wondering, will I have to pay taxes on the profit? And the answer is maybe. But many homeowners don't pay a dime on the profit from selling their home in taxes. Welcome back to the channel. I'm Joe, a licensed certified public accountant with over 10 years experience in corporate and public accounting. I have an extensive background in accounting, audit, and taxes, and I'm all about helping you take control of your money by living smarter. Be sure to subscribe to the YouTube channel and turn on all notifications. And be sure to check out the blog site where we post every Monday, Wednesday, and Friday. In this video, I'm going to explain how the IRS taxes home sales, the $250,000–$500,000 tax exclusion, situations where taxes apply, and strategies to reduce or eliminate your tax bill. So, let's get into it. Let's start by getting a good understanding of what capital gains are first. When you sell your home, the IRS looks at something called capital gains. Now, what is this capital gains? This is simply the difference between what you sell the home for, which is the selling price of your home, minus what you originally paid for it or our adjusted basis. And then whatever that difference is, if it's a profit, that's what we're going to call our capital gains. Now, what is included in our adjusted basis? Our adjusted basis includes the original purchase price that you bought your house for, plus any major improvements. Maybe you renovated the kitchen, got upgrades to the bathrooms, or did some other home improvements, added a new roof, plus certain closing costs. That's going to be our adjusted basis. So it's going to be our selling price, where we sold our home from, minus our adjusted basis. And if it's positive, that's going to be what we call a capital gains. Let's look at a quick example. Let's say you buy your house for 300,000, and then years later you sell it for 500,000. Your profit or capital gain is going to be the 200,000, 500 minus 500, which is the selling price, minus 300, which is your adjusted basis, gets us to a capital gain of 200,000. Now, normally capital gains are taxed, but homeowners get a huge tax break. Let's take a look at something called the home sales tax exclusion. The IRS allows homeowners to exclude, depending on your filing status, if you're single, the first $250,000 of that capital gain or profit from the sale of your home. And if you're married filing jointly, that amount goes to $500,000. This means many homeowners pay zero taxes when selling their home. But there is two key rules. Let's take a look at the two rules in order for homeowners to qualify for this exclusion. To qualify, you must have owned the home for at least 2 of the last 5 years, and also you must have lived in the home as your primary residency for 2 of the last 5 years. If you meet both of these tests, you qualify for the exclusion, and the 2 years does not need to be consecutive back to back. So, what this means is this is more so for the living part. If you lived there for 1 year and then maybe your job took you away, or for whatever reason maybe you went across country or you lived in another country for another year, and then you came back and lived back in your home for another year, that still qualifies for two years of living in that home. Let's take a look at a really good example. Let's say a married couple buys their home for 300,000, and then 10 years later they sell it for 700,000. Their capital gain or profit from the sale of their home was 400,000. Since the exclusion for married couples is 500,000, they pay zero in capital gains on the sale of their home. Let's take a look at when you might actually owe taxes. You may owe taxes if your profit exceeds the exclusion. If the property was a rental or investment, it doesn't count. So if you go to sell it, you're going to have to pay capital gains taxes on it. If you depreciate it, you're going to have to, if you have some depreciation, you're going to have to recapture a portion of that depreciation. And if you didn't meet the residency requirement, remember, 2 of the last 5 years, you have to have owned it and also made it your permanent residency in order to qualify for the exclusion. Let's take a look at another good example. So let's say you're still that married couple and you still bought your home for 300,000, and then 10 years later, instead of selling it for 700,000, we're going to say you sold it for $950,000. So we take our selling price, 950,000, minus our adjusted basis of 300,000, and that leaves us a profit of $650,000. So with the merit exclusion, that first 500,000 on the profit will be excluded. So that remaining 150,000 may be taxable. If the property was a vacation, rental, or investment property, the exclusion doesn't apply. Remember to keep your receipts anytime you make a large home improvement. One of the best ways to reduce your taxes is by tracking home improvements. Some examples include kitchen remodels, bathroom renovations, roof replacements, any additions, new HVAC systems. These costs help to increase your basis, which lowers your taxable profit. You may be asking yourself, what if I sell my home 2 years before I reach my exclusion? If you sell your home 2 years before your 2 years, you may still qualify for a partial exclusion. If the move was due to a job relocation, where basically, if your job's telling you got to go across country because we're getting rid of the current location of where your job is, then that qualifies. But if you're just applying for a new job um, across the country, that's not going to qualify. So remember, it has to be where you're basically being forced out of your job because of something that's out of your control. If you have health reasons, certain health reasons that happen, maybe you no longer care for yourself, so you have to go live with a relative or a friend in order for your health reasons, or you have some rare disease that causes you to need to go into care for someone else, that account. And if there's some kind of unexpected life event, life does happen. The IRS understands that, so it just depends on what that life event may be. You could still qualify for a partial exclusion in all three of those. Selling your home can be financially rewarding, and thanks to the IRS's home sale exclusion, many taxpayers pay little or no taxes on the sale of their home. But the small details really do matter, especially if your home was a rental or if the gains exceed the exclusion limits. It's always smart to consult with a tax professional to be sure you understand the tax consequences of selling your home. If this video helped you out, be sure to like and subscribe for more tax tips. And come back next week when we'll talk about what is taxable income.